The current investment and economic landscape is complex and fraught with difficult issues. The Russian invasion of Ukraine and the international response are having a substantial impact on the world energy supply and international cash flows. In the United States, inflation remains at a 40-year high, and prices on everything from food to automobiles is steadily rising. Stock markets around the world are declining, and some think that a recession may be coming soon. This is a difficult time for anyone to try to manage their investments on their own. Thankfully, the guidance of a professional financial advisor can help investors weather this storm and find clear sailing beyond. Hello, I'm David Frederick, Director of Client Success and Advice with First Bank Wealth Management. In this video, I will briefly discuss the value of a professional financial advisor for times such as these. In a separate, longer video, I will discuss the role and benefits of financial advisors in greater depth. There are many options for do-it-yourself investing these days. Whether it's E-Trade or Robinhood, individuals often have a sense that they can pick a winner stock and get rich overnight. Even more established investment services like Vanguard and Fidelity offer individuals a chance to manage their own stocks, bonds, and mutual funds. But is this the best idea for investors, especially in a difficult economy? Do-it-yourself may be appropriate for some people with some projects, but going it alone with an endeavor as important as managing a life savings during a period of high inflation, international conflict, and potential recession may be confusing, inefficient, suboptimal, and even dangerous. Professional financial advisors can have many tools that can help investors navigate the economic landscape and find the best path forward. First, financial advisors can help their clients by constructing a financial plan. A financial plan is a way of connecting an investor's assets with his or her lifetime goals. Often investors try to go it alone, do not have a financial plan, either because they do not know how to construct one, or they simply do not have access to the necessary tools. But a financial plan is key to good investing, and it serves as a guide for every step the investor and the financial advisor take together. With a financial plan in hand, the financial advisor will help to manage investment behavior. We all know that to make money in investing, we need to buy low and sell high. But emotional investing generally tells us to do the opposite. For instance, when we see a stock going up, our feelings may tell us to buy it and join in its success, even though it may be near the top of its value. Worse, when we see our investments start going down in value, we may panic and decide to sell them, even if we lose money for doing so. Financial advisors understand how the market goes up and down and will provide solid advice based on data and professional perspectives, not emotions. Financial advisors can also provide a number of technical services which may be beyond the abilities of individual investors. For instance, financial advisors can find an optimal asset allocation, which is the relative proportion of stocks, bonds, and other assets in a portfolio. As part of the asset allocation, financial advisors will examine and vet investments to make sure their costs are in line with their expected returns. They will also rebalance the portfolio regularly as it grows to make sure it stays on course with the financial plan. Financial advisors are always minding the shop on behalf of their clients, so their clients do not have to be constantly worried about their investments. In 2016, Morningstar, an investment research firm, assessed the returns of investors working with professional financial advisors in managing retirement assets against investors managing such assets alone. The study found that individuals working with financial advisors attained a net average return of 1.82% per year more than those going it alone. This return would produce, on average, 29% more retirement income. Vanguard, an investment firm, has been studying the value of financial advisors for nearly 20 years. They have concluded that financial advisors who follow all of the best practices for wealth management can attain an extra return for their clients of roughly 4% per year. While returns certainly differ and assets can go down as well as up for anyone, these studies tend to show that investors with financial advisors may have better results than those without. If you would like some professional help and advice navigating the current economic and investment landscape, I encourage you to reach out to a First Bank financial advisor for professional perspectives and support. You can reach me directly at david.frederick@fbol.com. Thank you.